Welcome back to Wealth-ology. For today's video, we'll be going to talk about how to make a 50% return per year explained by Warren Buffett. Let's get started. Strategy number 1. Invest in small cap stocks. Warren Buffett has to look at the incredible huge stock since he oversees billions of dollars. There's no use in Buffett investing $1 million in a smaller company because even if he profits $500,000, it won't matter when compared to the billions of assets he manages. However, if Buffett could only raise $1 million, he could invest in those tiny businesses and significantly improve his overall portfolio. If he produced $500,000, it would have an impact on his entire portfolio and give him a 50% return, making it worthwhile. When asked how he would accomplish these extremely high returns, Warren Buffett started the following. Buffett said this: "There are tiny little areas, as I said, in that Adam Smith interview a few years ago, where if you start with A, and you go through and look at everything, and look for small securities in your area of competence, where you can understand the business and occasionally find little averages, situations, or little wrinkles here and there in the market, I think working with a very small sum, there's an opportunity to earn very high returns." So basically, he's stating that you should start like this. The first step is to decide on a topic that interests you. This may be artificial intelligence, the semiconductor sector, gaming, cryptocurrency, or anything else. You choose their field and become an expert in it. Then you examine the little stocks in the industry, stocks that you can comprehend. And as long as you go through all these equities, you'll notice minor wrinkles, hidden jewels, and averages opportunities that can help you make a lot of money. But the key is to pick an industry that you can understand and that you're interested in, and then look at all the small stocks in their industry and you will find the deals. Strategy number 2. Look at USA stocks. Chinese small caps are dodgy. And strategy 2 is a use to strategy 1 to look at smaller corporations, stocks, or companies in the United States. Warren Buffett favors US securities because they are the ones that made him wealthy. And the United States has a reputation of being dependable and business-oriented. And when it comes to small businesses analysis, you need to be able to trust the figures in the data they provide. And you can pretty much believe this data when it comes to American companies. The Security and Exchange Commission and other agencies govern the stock market in the United States, ensuring that each figure issued by these corporations is accurate. However, you can't really believe the stats that the stocks put out if you invest in small companies in particular nations, such as China or third world countries. And if you ask Americans or certain Westerners residing in China, or individuals in other smaller third world countries, they will tell you the same thing. The regulation business practices are just not comparable to those in the United States of America. As a result, if you're looking at smaller enterprises in those other nations, you don't know if you can believe those data, and there's simply too much danger in those countries. According to Buffett, the United States is the best place to do it. Strategy number 3. Invest well before intrinsic value. The third strategy is to acquire equities only when they are selling for a fraction of their intrinsic value. And that's one of the great things about small cap stocks. They're often overlooked. There are plenty available with prices much below their true value. Big companies like Netflix, Amazon, and Microsoft are often scrutinized by so many analyses that they don't offer the same prospect as others that have been scrutinized as extensively. So, if you're looking at small cap stocks, make sure you understand how to assess their worth, and everything will fall into place. Only purchase them when the price is far lower than the intrinsic value. This is how you secure extremely large profits. For example, the green line here indicates the stock's intrinsic value, whereas the black line reflects the stock's price. Because most investors invest based on their emotions, the stock price is quite volatile. However, the stock's value has remained relatively constant. What you want to do is purchase this undervalued stock winner. The bigger the predicted return, the less you pay for a stock. For example, if a stock earns $1 per year and you buy $10 for it, you made a 10% profit. However, if you pay less than $10, say $2, you will receive a 50% return on your shares. It's really basic math. Strategy number 4. Be fearful when others are greedy and greedy when others are fearful. Emotions are powerful motivators for investors. Consider Tesla stock. One minute, they're the happiest set of investors, believing they'll become wealthy. The next minute, they're all panicking because quarterly earnings are done, and they're running for the hills. You can make a lot of money if you take a step back and look at the facts, and you'll find that the finest times to make money are when everyone else is afraid and when everyone is fleeing for their lives. This is the time to invest in stock. Take a look at how Facebook stocks has performed over the last year. Investors got concerned about privacy risks halfway through 2018, and the recent scandals such as Cambridge Analytica and Alic Accord, and the stock plummeted like a meteor. When the Facebook stock was cheap, this was the perfect opportunity to invest. We never announced that we were panicking. We had to flee because we were terrified. When you look at the statistics and the fundamentals were great, earnings were still high, user numbers were climbing, and the company was still expanding. There's a probability that a stock market meltdown will happen in the near or medium term. You can make a lot of money if you keep your emotions in check and buy equities when they're falling, similarly to those investors who purchased in 2009. Strategy number 5. Keep turning over pages. At the end of the day, those that turn the most page and analyze the most stocks are the ones who will do the best in terms of investing. The great investor Peter Lynch said this: I always said that if you look at 10 companies, you'll find one company that's interesting. If you look at 20 companies, then you may find 2. If you look at 100, you will find 10. The person that turns over the most rock wins the game. The more stocks you go through, the more shareholder reports you read, the more YouTube videos you watch, and the better your investors' returns are going to be. Generally speaking, and you know when Warren Buffett, he stays the same thing. He said, when I started, I went to the manuals page by page. I went to 20,000 pages in Moody's Industry, Transportation, Banks and Finance manuals twice. I actually look at every businesses, although I didn't look very hard at some. Over time, reading has made him wealthy. He related a story about looking through Moody's annuals in 1951, and how is it all about turning pages. And the more pages you turned, the more stocks you research, and the more you understand about investing, the better your returns will be. So, which of the Warren Buffett strategy have you found to be particularly beneficial? Please let me know in the comments section below. And if you like this video, please give it a thumbs up, turn on the notification bell, and subscribe to our channel for more. Thank you for taking the time to watch. Stay tuned for our next video. Bye!